All right. Good evening, everybody. Welcome to this week's Mastermind. And we are getting everything set up here. Okay. Making sure that we are live on YouTube, and you can find us on both the Zoom and YouTube. Actually, it says I'm Joseph Smith, but I'm not Joseph Smith. My name is Ray Fleming. Joseph Smith is my partner in doing good. And today we are covering the very beginning steps of credit banking. So like I said, you can catch us on YouTube. Currently, we are on the Velocity channel. Thank you, Mr. CJ Wallace, for inviting us out. We are always grateful to be a part of your channel and the good that you are doing and helping others. So what are we diving into today? This is excellent. If you are just tuning in right now, this is the start. This is the start of a fresh month for us. And we had finished up last Tuesday, we had finished up the 4-part series on credit banking and the full extensive training and really diving into actually credit banking in conjunction with building business credit. So this week, fresh start with the favorite B word in the world, budget. So, but before we dive into all that, like I said, my name is Ray Fleming. I am a co-founder of a company called Wise Guys and Ties. You can always reach out to us at 888-524-9273. Email us at businesscredit@wiseguysandties.com or visit our website where you can find all things business credit. Now, if you'd like to partake as a case study in our Credit Banking Mastermind, all you need to do is go over to Wise Guys and Ties /credit-banking / and this is taking place every Tuesday night, 8 p.m. Central Standard Time. Wait, everything just changed though on Saturday, but right now we're at 6 p.m. Pacific time. And we're going to dive into this today, folks. But if you want to fill out this form, all you have to do is go through, fill out your available credit limits, your home loan amounts. We don't need any personal information, but down in the current situation box, that's where you can really break it down. Interest rates, loan amounts, terms, and everything of that nature. Also, we do have 30-minute consultations. We do ask that if you want to dive into deep on credit banking, that you fill out this form before we're doing a consultation. But what is the lost American dream, folks? That's really financial freedom. Over the years, it has been stacked heavily against us to not be able to achieve financial freedom. And the reason for that is because of many reasons that we're going to dive in. But financial freedom happens when your passive income equals your monthly expenses. So if you take your monthly expenses minus your passive income or retirement funds, however you're receiving funds passively, equals your financial freedom goal. So for example, if you needed $3,000 a month, or that's your monthly expenses are $3,000 a month, you currently have no passive income, then your goal is to get to that $3,000. So how much will you need to invest to create the passive income you need to actually reach your financial goal? Well, we got to take your financial goal and divide it by how many months we have in a year. We tend to live on a 30-day basis or a monthly basis. So that's really the way we're going to look at this, is taking our financial freedom goal and we're going to divide that by 12. Okay. And then once we get that number, we're going to have to divide that by the rate of our a return of investment. That will equal our total investment amount needed. So for example, if we're shooting for $3,000, we're going to have to divide that by 12. So 12 months, we're going to divide that. And then we, are going to divide it by whatever percentage rate we are getting as a return on our investment. Now, 10% on a monthly basis is absolutely, or on an annual basis, that is definitely doable. Maybe not in all the traditional investment routes as far as mutual funds or index funds. Well, touchy subject right now as stock market's been a little bit haywire, but The great thing is there's a lot of investments out there that are not heavily affected by the stock market, for example, real estate. And so it just really comes down to where's the money at? And if you're getting a 10% return on investment, well, you're going to need $360,000 invested in order to achieve your financial freedom goal. So what keeps us from financial freedom? Well, we're kind of touching base on it earlier. It's out of control debt. So how do we actually get our debt into control? And that is where the lost American dream is. You need a map. You need a roadmap. Wherever you wanted to travel, if you wanted to travel anywhere into the country, you could actually do that. If you're living in America, you can literally get anywhere as long as you get onto a freeway. Even at nighttime, as long as you can see 200 feet in front of you, somebody's already laid that path for you. And so all you have to do is follow the map, the plan that was laid out, and you can literally learn from other folks' failures. So let's see what this looks like. We have budget, we have lines versus loans, and we have credit banking. And like I said, today is the first day we are diving into my favorite topic, the budget. Because in order to achieve financial freedom, you have to get serious about managing our funds. We have to get serious about our financial situation. We need to keep track of it. It's similar to anything. If you don't pay attention to it, it's easy for it to go unnoticed, or it's easy for something to just, out of sight, out of mind is not the way to go about doing this. And unfortunately, that's a lot of folks' mentality on their retirement accounts and also their finances is, out of sight, out of mind. I'm afraid to check my checking account. Ooh, that is how you run into a financial problem, is not having all these health checks and being consistently up to date. What you focus on expands. So if you focus on your finances, you will be able to get a hold of it. So what I'm going to use is to demonstrate this, I'm going to give you the averages, national averages that come from the Bureau of Labor and Statistics. Now, for national average 2 working household, the take home after taxes and expenses is $5,000. Now, when we receive our monthly income, where do we put those funds? Where are we putting them? Well, we usually send them over to a bank, checking, savings, and I challenge you to start to ask yourself, why? Why are we doing these things that, for example, why are we putting our money into a bank? And some of you may be thinking, well, I don't know, that's kind of what my parents did, and my parents' parents did, or that's what everybody said to do. Ultimately, it comes down to the bank. The bank has taught you what to do. Now, are banks fiduciaries? Are banks are they nonprofit organizations? I challenge you to continue as we're going through this. Think about really what the bank's motivation is to really storing your funds. Ultimately, the bank is there to make money. And the only way that they can make money is if they have your money. And so that is why everything that you have been told is to basically train us to put our funds into the bank so the bank can use them. Now, once we put them in, ooh, watch out for that. All right, so once we put in, we got to start to budget for everything. Now, the first section of the pie that we're going to break off is for, in this case, a loan. If you have a home loan, a mortgage, right now we're going to start to break this down. On the right-hand side of the screen, you will see that, let me make sure that you can see that. Let's see, are you able to see this? That my picture is not covering it up. Okay, so right here in the upper right, right underneath my picture, you'll see I'm going to start a category of what we like to refer to as loans. $1,200 a month on a $200,000 mortgage, and the national average is still 6%. Now, the reason I bring this up, we have to budget for our living expenses. If you are renting, then you would portion this piece out to be allocated towards your rent. It's one of the first things that we start to store money for. Now, the other problem of when we start to actually put our money into an account and then break it off into pieces of a pie, we are living on what's called the cash basis mentality. Now, the reason that this is bad is because it starts to breed scarcity, that there is not enough money because we are only looking at the piece of pie that we have. And then it starts to fuel other insecurities as if we see somebody else gaining or growing or making money, we tend to think that, hey, they're maybe taking some of my pie or some, it creates competition in the workforce, oh, I don't want to be celebrating that person's promotion. They're taking some of my pie. And that is designed to keep us in a scarcity to be able to achieve financial freedom. It all goes back to a design that has been implemented by some very powerful forces to keep us in the bondage of financial troubles. So as we put the loan onto the other side, we also need to look at a two working household income needs to get to work. So they have 2 vehicles, and we're going to also put the auto loans underneath the loan category. So 2 vehicles totaling $600 a month in payments, carrying a balance of $26,000 for those vehicles. The next piece of the pie is credit cards. Now, this was a little bit shocking, but we're going to actually move over to the other side of the screen here. If you look on the left-hand side, lines of credit. Now, we're going to talk about these a little bit differently. Loans are not the same as lines of credit. They are amortized completely different. But the national average is $15,000 of limits. This could be between 3 to 5 credit cards, but they're carrying a $12,000 balance at a nice little 21% interest rate. Yikes. And that is $600 a month that they're paying towards their minimum payments. So the other aspect of what we have going on here is our lifestyle. $1,200 allocated towards your lifestyle. This is going out to eat. Are you paying for Netflix, Hulu, and Amazon Prime? Are you buying stuff from Amazon? Do you like to go out to the movies? Really, what is your lifestyle and what do you spend money on? Basically anything that is not your house, your car, or your credit lines. Next, we have to take a look at the savings. National average currently is $1,400 is being put towards savings. A lot of times though, what ends up happening is we start to run out of money before we run out of month. So the savings account really becomes a put and take account where we put it there for that, to save it, but we ran out of some money, so we transferred it back to the checking before the end of the month. Now, the other aspect of the savings account is 401ks, IRAs, child education accounts. A lot of these are viewed as long-term savings accounts. Now, the other aspect to this is why is there a savings account? Is it really designed for you to save effectively? Well, what is the return on a savings account? Anybody? And also, as we're going along with this, we heavily encourage, participation. If you're on the Zoom call, you can always send it through in the chat box, or if you are on YouTube, you can definitely send it through the chat box on YouTube. But the reason that it is called the savings account is to make you feel good about putting your money there. And then the issue comes into, is that completely true? Well, if I'm a bank and you bring me your funds, I'm going to say, well, you should put it into the savings account and start to save for that, that rainy day, or, you may want to buy a house or buy another house or buy a car. But so let's start to save it up in this pile over here. But in reality, what it is it's the bank's lending pool. As soon as you start to put money into a savings account, they can start to lend those funds out. And because we are on a fractional reserve banking system, they can actually lend out, 9 times of what they actually have on deposit, which is really why they want to have as much money as possible into savings accounts. By doing so, all we're doing is giving them more money to lend out. So if we are, and this is what I'm going to challenge you to start thinking about, is why are we doing certain things? And then when it comes time to actually buying that vehicle, why are we not using our savings accounts, but we will take a loan out? Now, with $5,000 in and $5,000 going out, if we look at this from a business perspective, if we're looking at from a cash flow perspective, if the revenue's 5,000 but expenses are 5,000, so everything is getting allocated, that doesn't leave us with any cash flow. That is a problem. So how do you know which debts to pay off first? Because now we got to figure out, okay, we're in debt. We got to figure out which ones to pay off. Identify which of your debts are the most inefficient. Because some folks might say, well, I don't know, do we pay off the biggest credit cards first? Do we pay off the loans first? Which ones do we pay off? Well, let's see. Should you pay off the biggest or the smallest debt, or the lowest or highest interest rate? That's a very, very good question. So use this formula to determine your debt efficiency. E equals B divided by P. So E is your debt efficiency. That is what we're trying to get. We want that answer. So the B divided by P, the B is your loan balance. So you would put your loan balance and you would divide your loan balance by your minimum payment. I'll show you a little example. So we have two loans that we're looking at, and we're trying to figure out the efficiency of these loan debts. So let me pull up a little calculator for you, and that way we can do this together. Okay, so if we have a $10,000 loan, so we got $10,000, we're going to divide that by 100. Which is going to give us an answer of 100. If we look at loan number 2, that is 10,000, and we're going to divide that by 1,000, which is the payment, which gives us 10. Okay, very simple to do. Now let's look at this. So since loan number 1 has an efficiency of 100 and loan number 2 has the efficiency of 10, how do we know which one is better? Well, you're going to want to use the debt efficiency continuum. So the closer you are to 0 on the efficiency is the more dangerous that loan is, or the more expensive and the least efficient it is. Anything below 50, you want to start to really focus on first. As you start to approach 100, that is where we want to be. If we can get all of our debts to be fully efficient at 100, that is the optimal place to be. And that, when you're at the freedom range, that is when you will be paying down your debts the fastest. So pay off the lowest number on the continuum first. That will basically, as far as the main training, now that was just to really start to tap into where we're currently at. You know, we have to figure out where we're at before we move forward. So I'm going to go over several other things tonight, but I want you to, between now and next week, I want you to gather your numbers. I want you to gather your home expenses. I want you to gather your vehicle expenses. I want you to gather any expenses that you have and start to break it down into different categories. So let's take a look at how we're going to set up our budget. I've got a spreadsheet here. All right, let's take a look at this. So here is a basic Excel sheet to use for credit banking and your household monthly cash flow and budget. You got to look at your revenue. Now, the numbers that I've inputted here are directly corresponded to the numbers that we just went through on the PowerPoint. So the wages, the take home is $5,000. And there's room here for interest, dividends, miscellaneous income, and total of 5,000. Now, it's important to understand that there's going to be several ways that we can start to hack our debt. And the first place that everybody goes is actually, can I reduce my debt? Or not my debt, but my expenses. Can I reduce my expenses? Where can we start to cut back on? What can we start to pull back from? But in a business if we start to think about our personal financial situations like a business, which we need to run our financial household like a business, and it's very important to stay on top of our taxes, on our balance sheet, our budget. We got to be able to stay on top of all these items. Now, in a business perspective, the first thing that we want to look at doing is actually increasing revenue. Absolutely increasing revenue. If you're bringing home $5,000, or maybe you're bringing home $2,000, wherever you're at, the first option is, hey, is there an easy way to start to increase my revenue? Are they offering, a little bit of overtime at work? Or does, one of your buddies, do they have a business that they're maybe looking to get a little help on the weekend? Or do you just know a business that needs help? Every single business out there is looking for three things: people, properties, and money. Now, when I say property, that could be actual physical real estate, that could be products, that could be whatever it is that they are buying and selling or doing. Every business needs help in one way, shape, or form. They need more customers. There is basically an unlimited amount of businesses out there that will pay you for providing, leads to them by bringing them business. In the first place, I usually say for somebody to go is, what's your hobby? What do you actually enjoy doing? Because also a lot of folks don't necessarily like what they do for work. And if there's something that you would much rather be doing than working, how can you make money for doing that? Now, if it's just watching TV, I don't know how to actually help you with that. But let's say that you enjoy, hunting. Yeah. Okay. So let's say you enjoy hunting. Well, there is a lot of ways that that could easily be turned into an extra revenue source or a business. So I know several folks that enjoy hunting. I'm not a big hunter myself, but I know a lot of guys who are really into hunting. Okay. And so I talked to them. I'm like, well, you spend a substantial amount of money on this hunting thing. You plan 2 big trips a year, and you go with a couple of buddies, and you spend thousands and thousands of dollars on these trips. So why don't you create a business that is all built around these hunting trips? All you have to do is continue to do what you were already doing. But instead of your buddies paying for all their stuff individually, they just pay you. And then as a group, you could probably get a better discount. All you have to do is run it through your business. And once you have a business, then it opens up the world of being able to offset taxable income and different things like that. I'm not a CPA, but I definitely have one that works for me. And there's a lot of ways for you to just turn your hobby into a business because you already enjoy doing it. Now, so that would be the first approach to, can we get some extra income? Is there other ways, is there a work from home? Could I do some scheduling? Could I do some, let's say you're a little bit older and you just want to work from home. Well, there's a lot of opportunities there to be a virtual assistant. You could basically just organize people's emails or schedule calls, and there's opportunity there as well. Now, if you're saying, hey, I have no free time, can't work anymore. Well, now let's start looking at, well, do you have Hulu, Amazon, and Netflix? Well, let's cut them back. Let's get down to one. Are there music streaming services that you're actually paying for that you really don't need? Many folks don't even realize that there may be a subscription that you're paying for on a monthly basis or a yearly basis or a quarterly basis that is so small that it just starts to come out. And unless you have a handle on, hey, what is everything that we are actually spending? I encourage you, as you're going through this, take a look at what you spend money on in a month. And let's say that you're doing pretty well. You're bringing in $5,000 a month, and you hit Starbucks, let's just say 2 or 3 times a week. Let's take a look at what that really looks like. Let's say that the average, let's say you're spending about $5.50 on a drink at Starbucks. So twice a week, we're getting Starbucks. That's $11. and then let's multiply that by 4 weeks in a month. That's $44. And let's multiply that by 1 year. That's $528. That's $528 that you might be paying interest on somewhere else. And if that's sitting on a credit card, let's multiply that by 21%, which is another $110. So we take that and we add that to the 528. So now we're looking at that Starbucks that's only twice a week is going to cost you $638. And if we're looking at, say, hey, for the next 10 years while we're working on trying to pay off our home loan, multiply that by 10 years, and all of a sudden you've spent $6,388 on some coffee. So not saying that you don't have to do that or that you have to eliminate it entirely, but literally cutting down to 1 day a week or once every 2 weeks. It's not completely living in scarcity, but it is just not overextending yourself. And as you start to do these little things, you actually will enjoy treating yourself a little bit more because you can look forward to that and you're like, hey, I was able to do that. Now, let's say you like, it's non-negotiable. You want to get coffee from the local, little coffee shop 5 days a week. You're like, this is just my thing. In order to deal with work, I treat myself every morning before I go to work. Fantastic. Well, let's compromise. Now it's time to start looking at, okay, if we're not going to focus on the spending issue, then we have to focus back on the revenue issue and bring in more money. Now, of course, me as a real estate investor, as a business owner, I am always looking for people, properties, and money. I'm looking for clients that need help with their businesses. I'm looking for folks that need help with their finances. Now, a lot of what we do here on Tuesday nights, we don't charge any of you folks anything. This is all just a service. So how could you help me? Invite your friends over to this. If you are finding value here, share it. Share it with your friends. Invite them over to partake in these trainings that we put on. Like I said, you can find these on YouTube or go to wiseguysandties/events, or you go to our event page on our website, and then you can sign up for any of our masterminds. We have 3 masterminds that take place weekly, one on credit banking, one on direct funding for your business, and then one on how to gain access to business lines of credit without using your personal social security number. Absolutely good stuff. So let's dive back into this budget as we, took plenty of time on that little side note. We have our home here. We have our mortgage that we've inputted here. Now, if you're doing rent, you can always modify it here, or your HOA, taxes, insurance, repairs, service, utilities, and total. Like I said, we've just basically put it in the basic information, but it allows you, you can just go online to request any of, you could go online and just say, hey, budget Excel spreadsheet. There's also a lot of apps out there that allow for you to do budgeting, kind of play around and see what works for you in your situation. Let's put it, you have your groceries here, childcare, dry cleaning, dining, house cleaning service, household items, also transportation, gas, really breaks it all down for you. Entertainment, health, your health insurance. Now, if we go back over to the right-hand side, vacations, maybe you're going to be saving up for that vacation. Recreation, so sporting events, children's sporting events, dues and subscriptions, magazines, newspapers. I'll tell you what, I receive a bunch of magazines at my house because they got me a couple years ago where it was, hey, you got some flight miles. Here you go, a free years of subscription. Perfect. But to get that subscription started, I needed to provide a debit card, even though they didn't charge me anything. And then all of a sudden, at the beginning of the year, oh, I completely forgot because it was 12 months ago when I did this thing that now they've auto-renewed the subscription for like $40. And it's basically, not to beat down on the magazines, but a lot of it's online now. And, the truth be told, when I receive my magazines in the mail, I kind of flip through it and it ends up in recycling. So internet, Pandora, Spotify, your music services, anything there, personal expenses. If you're going to actually spend money on anything, before you spend money on things that are going to depreciate, spend money on books, on audiobooks, on education. There's a whole lot of education online now for whatever it is that you want to get better at. I've spent a lot of money on personal education, and especially online education. I would say that I am somewhere close to $30,000 that I've spent on online education. Um, Everything from business, finance, to real estate investments, to personal finance. And it was worth every single penny. Now, of course, there's a lot of things out there, and this is not the time to talk about it, but if you ever want to get on a free consultation, I can always talk to you about, hey, what have I done that worked for me? What did I spend money on that actually worked? I mean, I bought in programs for, $1,500 that basically I don't think it was worth it. And I've spent money on a program that was $20,000 and I think it was completely undervalued. I probably should have paid 50 grand for it. So it really comes down to who's actually providing it. And just so you know that you can use this as a resource. If you're looking into doing something, if I don't know from personal experience, I may know somebody that had a similar experience, and hopefully I can point you in the right direction. But I will encourage you guys to really work on inputting your numbers in the spreadsheet. Now, if you need this spreadsheet, if you're like, hey, I've looked around, I didn't find anything, and I like that Excel sheet that you have, Ray, well, you can always go over to Wise Guys and Ties. Let me pull this up. You can always go here. You can go to the Wise Guys and Ties /credit-banking. And if you go here to the Wise Guys and Ties /credit-banking, in the fields here, you put your name, your email, and your phone number. You check the boxes, and then down in the description below here, the current situation, say, hey, can I get those Excel sheets that you were taking, that you were putting out, because I want to get my numbers ready for next week's mastermind. Totally okay. Just go ahead and do that, and then that way we can get those sent out to you. All right, so let's hop back over here to the budget, but that pretty much wraps it up for the budget. So like I said, next week we're going to show you what to do with your budget once you already have it. This week was just directed towards making sure that you get your budget on paper. That's really what it is. Getting it down, or not necessarily on physical paper, but get it in your computer, get it somewhere where you can start to have eyes on where your money is. Now, the next thing I want to talk about is our weekly case study. So every single week we go over a different case study of people that have submitted their information and their numbers. And this week is no different. So we are on Mastermind number 10. Wow, it's already number 10. That means it's literally, we started this, the beginning of January. We're on our 10th Tuesday of doing this. So if you're part of this, I'm grateful that you're here for this experience. So this is interactive, and I'm going to be asking you folks questions, and I'd love to have your feedback. I'd love to have your input. Like I said, you can enter in your suggestions through the chat box on Zoom, or you can enter it in through the Velocity channel on YouTube. Okay, so just taking a look to see if we have any questions. So Willie says, so it's best to take your money out of the put into your business account. Oh, yeah. So a couple different questions on business. Oh, let's see. But Willie, let's see. Got Joseph on the line responding. Great response from Joseph. Credit banking requires you to use your line of credit to take a chunk out of your debt and run your monthly income and expenses through your line of credit. Your line of credit will be paid down by the cash flow you have. All right. Yeah, and next week, I mean, that's really what we're going to be diving into, is the difference between your lines of credit and your loans, really getting into the nitty-gritty on how those are really different from each other. So as we see on the screen here, Mastermind number 10. This is a case study of somebody that had submitted their financials, and they said that they are receiving $9,000 comes in monthly, but they have $7,203 of monthly expenses. Now, what is the cash flow? If you have $9,000 coming in, and and you have $7,203 going out, what is the cash flow? All right, let's pull up the calculator here, and then if you beat me to it, please, let's hear it, which some of you may. Okay, we got $9,000, and we have these, we're going to subtract by our expenses, which is 7,000. Oh, Poker Paparazzi says 1,800 about. Yep, pretty darn close. 203, that leaves us 1,797, just about 1,800 bucks. Good job, Poker. And so we're going to go ahead and add this into our notes here that we're at 1797 on our cash flow. Not bad cash flow. Now this household, you know, they're $9,000, so they're working. They got their expenses, and they have a decent amount of cash flow that they can start to hack down their debt. Now let's take a look at this. Available credit. In their total available credit lines and cards, $146,000, 425. This is not something that we get to see all the time. You know, many folks are starting with maybe a $500 or $1,000 credit card, but if this is what you could be working with when you properly manage, you know, credit lines. And so what are they currently carrying as far as a balance? $24,319. Now the interest rates are actually, there's a couple different interest rates. We'll go over those in a minute. Their home loan currently is at $387,000, 464.31 cents. It was a 30-year loan. They are currently 5 years into it, or actually they have 302 payments left. So that is what we're going to be looking at. So they got so they have a lot of credit. They have, you know, decent balance of credit. Almost $378,000 home loan. They have a good interest rate at 3.75, monthly payment of $2,681. If we look at the breakdown of these lines of credit, so excellent, a HELOC, home equity line of credit. So that is actually, there we go, HELOC, home equity line of credit. So they have access to $61,000 in their equity. They're currently carrying a balance of $23,214. That's at 5%. And this is okay, because the great thing about your HELOC, well, let's talk about this. Help me calculate the utilization. Okay, so we got a question that just popped through. What is the utilization? Oh, this is a great question. So what is the utilization? How do we figure out utilization? Well, what you're going to do is you're going to take the balance, and then you're going to, so the balance would be the $23,214.95 cents. And then you are going to divide that by the limit. And the limit is the $61,785.05 cents. So let's pull up the calculator, and we will do this, and let's see who can beat me to it. 61785, and I'm going to go a little slow so we can all see it. And if anybody on YouTube beats me, I would love to see that. So we got $61,785.05. Now we're going to divide that by the you know what? I'm already doing it wrong. We got to start with the balance, $23,214.95 cents. Pardon my French here, folks. The balance, $23,214, and then we are going to divide that by the $61,785.05. That leaves us, now you could, is that right? Did we do that correct? 23,000, yep, that looks pretty good to me. You could leave it in the decimal form, or for simplicity, you can multiply it by 100, and you can see an easy to read percentage rate of 37.57%. Okay, now we're going to add this into our utilization here. Now, the beautiful thing about HELOCs, as long as your HELOC is coded correctly. Now, I don't want to say that this is a blanket statement. I mean, there can be some coding issues. As long as your HELOC is coded correctly, it will not affect the utilization of your personal credit. It shouldn't affect your personal credit utilization. So with that being said, make sure you're keeping an eye on your credit report. Make sure that if you have a HELOC or you have some lines of credit, take a look at how are these reporting? What, if there's any discrepancies there. If your HELOC is reporting on your utilization, you got a problem there. We got to go get that solved with the bank. Now, let's move on to the next line of credit that they have. So they have another line of credit with a $40,000 available credit, no balance. So since there's no balance, we have no utilization. And the utilization, for those folks that, if you may not be familiar with what utilization is, let's say that you have a $1,000 credit card, and if you're carrying $500 on that, that's a 50% utilization. Once you surpass 50%, that's when it really starts to heavily negatively affect your business or your personal credit score. Utilization on most scoring models is 30% of your profile, which is another thing in a future week that we're going to dive into, is really, how do you, what are the factors in your personal credit? But it's really ideal to stay under 30% on your credit utilization for optimal usage. All right, so let's take a look at this credit card. We have a credit card available balances of $19,650, and they're currently carrying a $1,105 balance. All right, 14.99% interest rate. All right, let's bust out the calculator and let's do the math. So what do we do? Where do we start? Which number do we start with? Messed it up last time. Let's not mess it up again. We are going to be starting with, yes, that is correct, the balance. So let's take the balance, which is $1,105, and we will divide that by the total limit, which is $19,650.91, leaving us this decimal, which you can see that this is actually a percentage of 5.6, but for easy to read, we can multiply it by 100, and we have 5.62% on utilization. Excellent utilization ratio there. This person has done a very good job of managing their funds so far. Now, the other aspect is they have a auto loan at $25,580, which is at a 2.9% interest rate. And then student loan number one, $12,000 at a 3.5% interest rate. And we also have student loan number two at $80,000 at a 6% interest rate. Yikes. Now, when it goes into figuring out the debt efficiency, there is a couple of issues that we have with the information that was provided here. We do need the payment amount. We do need the payment amount. And so don't necessarily have the payment amount here, but I have a couple of, I have some experience with very similar student loans, so I can pretty much guess where those payments are going to be about. All right. This is the situation. This is the current state of this person's union. So what do we do? What do we do? We gotta get out of debt. I mean, we got almost $100,000 in student loan debt, another $25,000 of auto debt, got another approximately $25,000 of line of credit debt, and $378,000 home loan. So we've got plenty of debt here. Which should we hack down first? Any suggestions? What should we work on first? Let's see. All right, let me see. Anybody suggestions? Let's take a look at YouTube. Anybody got any suggestions here? Well, we could start to look at highest interest rate. Okay, so let's take a look at that. So Poker Pops Rodsy says highest interest rate. Let's take a look at that. Where is our highest interest rate? So we do have this 14.99%. And let's take a look at that. Do you remember how to calculate the debt efficiency? Let's talk about the debt efficiency. If we go back to our training, we have let's go back. Let's go back to the efficiency. So what do? We take the loan balance and we divide it by the monthly payment. So we have the loan balance divided by the monthly payment. So let's see what we have here. We got a couple loans. So we got the credit card here. Let's just take a look at the home loan first. Since that's the biggest amount, let's take a look at what the efficiency of that debt is. Got a couple other, let's see, should we pay off the car and the student loans first? Should we pay off the car? And okay, so that's a great question. We're going to look at all these. Let's start with the mortgage, and then we're going to work our way down to the student loans as well, and we'll see which ones we want to pay off first. So as we look at the efficiency of the debt, we want to take the loan balance and divide that by the payment. So here is the loan balance. Let's pull out the calculator. We have $378,464 and 95 cents, or actually 31 cents. 31 cents. So we're going to take the loan amount and we're going to divide it by the payment. Currently our payment is $2,681. So in this payment, we're also looking at, let's divide this by 2,681. Woo! Wait, so is that correct? No, we messed up somewhere. Let's see, what did we do wrong here? All right. Let's take a look at this. Minimum payment. So we have the loan divided by the minimum payment. Okay. Wow. All right. So, that's correct. All right, it is correct. So I'm looking at here. All right, so we got 441. All right, 441. Now, the next thing is, if we look at the student loans, and I'm going to pull up some of the notes here that I have as far as on our student loan debts and what we're usually looking at here. Got an auto loan payment. Let's take a look at the auto loan payment. So the auto loan payment here is, as I look at my notes here, 376. 376. Okay, so let's run a little calculation on the auto loan. So if we know that the home, we'll put some notes here, the home was at 141. Now let's do the auto loan and let's calculate the efficiency of that one. Okay, so the auto loan, we have a current balance of $25,580, and we're going to divide that by 376, which leaves us a 68. Not too shabby, actually. That's a pretty decent number. Okay. Okay, And let's take a look at the student loan. The student loan payment, this is, let me take a look here. Okay, $78. Okay, so we got this $78. Let's take a look at the efficiency of that debt. We have a $12,000 balance, and we are dividing that by 78. Ooh, oh wow, it's 153. That is not ideal for what we're doing. Really, anything over 100 is actually bad. So we don't necessarily want to do that. We want to, let's see here. Okay, I'm going to pull up the next student loan here. So we got this student loan, and the efficiency on this is 153, 253. And let's take a look at the next student loan. So we have 80,000 at 6% interest. And let me find where that is. We have student loan. That is, as we run the calculation on that, yikes. Wow, that's 412. That's $512. $512 that we're on that. Okay, so $512. Now let's figure out the efficiency of this debt. $156. So it's interesting. Both of these are very, very close. So student loan number 2 is at 156. Okay. Ooh. Now, as we're looking at this, we want to, now I want to show you where we actually start to plug some of this information in. I'm going to plug in the information over into a velocity graph and chart. So I've already kind of done this because I'm going to need to show you this in order to figure out where we go from here. So when somebody starts with this, you first need to actually put in what we're looking at as far as our home. We're going to look at the home first. Now the home balance was the $378,464. We have the interest rate here at 3.75, which corresponds to the information we already knew about the home loan. Then we have the term in months, which there's 302 months left. Total debt payment and the free cash flow. So currently there's $1,797 left. Yes. Okay. So Craig says get rid of the auto loan first. Let's go back to the auto loan. The efficiency of the auto loan. All right. Yes, as far as the efficiency in the auto loan. Now we are at $25,000. But we're looking at the 2.9%. We have an efficiency of 68. Yes, guys, I like the way that you're thinking. I like the way that you guys are thinking. Student loans are a little bit more inefficient. Now, well, before we dive into there, I'm going to go back over and finish going through inputting in the mortgage, because this is going to help us calculate the other aspects of what we're looking at. So I want to see where we're currently at by just implementing our velocity strategy with our home loan. And then we'll carry over and look at all the other debts too, because what's important to understand is there's a different product on here that many folks don't already have, and that's the HELOC. So if you have a HELOC, this can actually play into your favor very well. And most likely in this situation, what I would end up doing is ultimately all of these debts will start to be transferred into the HELOC, even though it's at a 5%. And even though we could really increase our utilization, there's a lot of power in having the HELOC. Now, there's one aspect of this that we do not know. We don't know how many years they've actually, don't know how many years they've actually had this HELOC. And as I mess up my little chart here, because many HELOCs, unless you are a service member, if a traditional HELOC is typically good for a draw period of 10 years. Home equity lines of credit. Now we're going to dive into lines of credit a little bit more next week, but HELOCs with a draw period of 10 years, and if you're with Navy Federal or another service branched bank, typically you can find 15 to 20-year draw periods on your HELOCs. But you will find out next week why we want to turn our line of credit into our new checking and savings accounts. Let's dive back into this though, but how are we actually going to get all this debt paid off quickly? And I'm looking at first this home loan. I'm putting the home loan into our credit banking calculator. Now we didn't exactly go over how to implement credit banking today, but just so you know that will be in the process. Today is the first stage, and as we start to build all of this, it will translate and come to fruition as we move towards the full training. So it takes about 4 weeks for us to go through a full cycle of credit banking. Now, taking a look at first the home loan, we have our, like I said, we got our balance here, we have our interest rate here, and we have our term in months. It talks about how much cash flow that we actually have available to us and how many years it's actually going to take us to get paid off the way it currently sits. Right now, just making the payments, we have 25 years left on that home loan. Total interest that's going to be paid is $206,000. That's a lot of interest, especially when it says your interest, we think, hey, a 2.75% interest rate isn't that much, but literally we're going to pay almost as much as the house is worth. What do we do? One of the things that many folks look at is like, okay, I can't pay off all the debts first, but I want to start to make some extra payments towards my home loan. Adding an extra $100, look at that. That will save over the life of the loan $18,000. That's huge. Let's mess with this a little bit. Let's say that you add an extra $500 of payments. Well, if you notice, that can actually save you $66,000 by adding an extra $500 a month. But something that you need to watch out for, all of a sudden, look at this, our cash flow, our free cash flow. So if anything were to happen, we've greatly reduced our available cash flow. We do not like the fact of eliminating the cash flow. It is something that we want to avoid, eliminating cash flow. You want your cash flow to grow as much as possible. So years to pay it off, 17 years, total interest paid $140,000, and the effective interest rate bringing it down to 2.54%. So if you're able to add an extra $500 a month, that's great. But is there better options? Well, let's take a look at when we take our debt and we implement basic credit banking. So we have 10%, we have the net income, which is $9,000. We got our total expenses and our monthly expenses. So when we do that, we have our free cash flow of $1,797. When implementing the credit banking strategy, by just changing the way that we pay our bills, it is able to free up almost $119,000, 980. Now, of course, that's looking at that there's no increases of income, there's no changes to the situation. Now, of course, we know that nothing is going to stay the same for the next 20, or, you know, in this case, for the 11 years. Income may come up, income may go down. There's always going to be variations. If you picked up some side income, then you would be able to start to hack down that debt a little bit quicker. Let's see, we got a couple of questions. Okay. All right. So we were able to, let's see, if you just start to implement credit banking, we are able to bring almost $120,000 back to your savings. That's pretty powerful. Now, the advance, we're not going to cover that today, but that's really implementing the HELOC strategy. And once you have a 40% equity in your property, that's when you can move to a first position HELOC. Now, this was important to understand that there is a lot of power in having access to the HELOC. There is a lot of inefficient debts here. Yeah, we're going to have to start to really hack away at these debts that are pretty high in the monthly payments. But what we need to watch out for is this HELOC and really looking at maximizing the usage of this HELOC to the best to our advantage. So we had a couple of folks, you know, saying, hey, let's look at the student loans, look at the auto loans. Well, let's go back to talking about how we calculate which ones are efficient and inefficient. If we look at this example and the efficiency, we want to look at, remember we looked at the loan that was 100 and we looked at a loan that was 10, and the debt efficiency continuum is the closer we are to the zero, caution, and as we approach 100, then we are more efficient, pay off the lowest number on the continuum first. So if we follow that and we look over here, we would go with the auto loan first. So we could hack out the auto loan. But see, the great thing is, since this is so inefficient, the auto loan, we have more than enough room to move this into our HELOC. Now, what's powerful of that is if we were to do that strategy, we could free up the monthly payment. We no longer would have that monthly auto loan payment, and we could add this to our cash flow. So even though there's a balance of the HELOC, and you'll learn in the upcoming weeks as far as how to actually implement the credit banking strategy, but if we're able to all of a sudden, by just transferring some of this debt, increase the pay down, if we go down over to our chart here, and we can now actually increase the income. If we increase the income by, what was that amount? We had 376. If we had increased that by 376, then you can see all of a sudden that takes us up to a savings of $126,000. All right. So there's a lot of different ways that we can actually move through this and make sure that we are getting out of debt faster. So future investments, savings, I mean, being able to implement the credit banking strategy is an amazing way to enhance the rate of return on your current loan debts, your investment debts, not your investment debts, but on, you know, the things that you are investing your money into in your life. You're buying homes, you're buying cars, you know, some of these can be looked at liabilities and assets, but the key is the true way to start to eliminate the financial stress is by eliminating all that interest. We end up spending so much of our life literally draining our money towards interest. Me personally, I really don't have any desire to continue to make the bank wealthy where I continue to struggle. In that case, I mean, really, I mean, we've kind of just started to touch base on what we actually do as far as credit banking. Now, today is just designed to really start the process. We looked at budget. You know, we were going over a traditional budget here. And what I want you folks to do, once again, your homework for the week is to go out there and set up a budget for yourself. Go set up a budget and find out what you're spending on literally everything in your life. You may not have ever done that, or you may do it, or you may think you do it in your mind. If you're keeping track in your mind, it's a whole nother thing once you actually get the numbers down on paper. And next week, we're going to talk about what you actually do once you have your budget all put together. We started to talk and touch base on how we're going to pay down these debts, but to really understand how we're going to do that, we're going to need to look at the real form of credit banking. But once you start to implement the credit banking strategy, you're going to see that there is savings of not only on the home interest, but as we start to roll in other debts that we have here in our situation, that you can start to eliminate these debts. And in this case, this house would be paid off in less than 10 years. And the other debts, the HELOCs, the credit cards, those are going to coincide along with that. As we start to free up more cash flow, then we can start to eliminate those very quickly. Now, of course, if you're going to be working with this calculator, these over here in this next tab with the basic credit banking, this is where you can actually adjust for those life-changing events. This schedule is built and designed for a traditional 30-year mortgage, and also how to look at when you start to implement HELOCs. And like I said, today I just wanted to show you this. We're not diving into this deep today, but there's a lot of aspects that we can mess around with here if you're going to be chunking down, and we can look at the chunk efficiency, which we will talk about more in future discussions. But if you have not subscribed yet to this mastermind, this is a free mastermind that we put on every single week. In the description on YouTube, you can tap in there and click the registration. You can register for this webinar. You can also, and you'll get weekly email reminders. You can also register for our business funding webinars that we have as well. If you take a look over at, let's see, if you go over to wiseguysandties.com and you go /credit-banking, there to be a case study. We'd love to have you submit your numbers, and then all we need is your name, your number, and your email. Then you need to agree to actually participate. We will not be sharing any of your information except for the numbers. So like the example we just used, we did not use anybody's personal name or information, but we did use their financial numbers. All you have to do is input your information there, and then in your current situation, go over the kind of the nitty-gritty. And it's going to be one of those things that maybe we need to set up a time just to make sure that we have all the information ready to go. That way we can effectively work through your situation. Once again, my name is Ray Fleming. You can contact us here at 888-524-9273. Also, bizcredit at wiseguysandties.com and wiseguysandties.com. You can find out all things on business credit, as well as on our YouTube channel. We have many different credit banking trainings for you available. But that pretty much wraps up our time for tonight. Wanted to thank everybody for being here and participating on this webinar with us. Good night, and God bless.